Preparing for a FP&A Analyst at Generali interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why are you interested in an FP&A Analyst role at Generali? Generali interests me because it combines a long-term insurance business with complex, international financial planning. I would enjoy analyzing performance across products and markets, understanding the drivers behind premiums, claims, expenses, and capital, then turning those insights into practical recommendations. The role also fits my strengths in Excel, financial modeling, data validation, and stakeholder communication. I am particularly motivated by FP&A's ability to connect operating decisions with profitability, resilience, and sustainable growth. While answering, connect your analytical skills to insurance economics, Generali's international scale, disciplined capital management, customer focus, and the opportunity to translate financial information into decisions for business leaders. Question 2. What does FP&A contribute to an insurance company like Generali? FP&A provides the forward-looking view that helps an insurer allocate resources and manage performance. I would support budgeting, rolling forecasts, management reporting, variance analysis, and scenario planning across premiums, claims, expenses, investments, and capital. In insurance, FP&A must also connect operational indicators with financial outcomes because claims development and investment markets can change results materially. My role would be to explain what happened, why it happened, and what management should do next. Make sure to cover planning, forecasting, performance analysis, management reporting, resource allocation, scenario modeling, and the distinction between explaining historical results and influencing future business decisions. Question 3. How would you build an annual budget for a business unit? I would begin by reviewing prior year actuals, the latest forecast, strategic targets, and the business unit's key drivers. For an insurer, these could include policy volumes, premium rates, claims frequency, average severity, headcount, acquisition costs, and investment income. I would build assumptions with operating managers, challenge inconsistencies, consolidate the schedules, and reconcile them to corporate targets. Finally, I would document assumptions, obtain approvals, and establish monthly monitoring against the approved plan. In your answer, discuss the planning timetable, historical analysis, business driver assumptions, stakeholder challenge, bottom-up and top-down alignment, consolidation, review cycles, and formal approval of the final budget. Question 4. What is the difference between a budget, forecast, and outlook? A budget is the formally approved financial plan, usually prepared before the year begins, and serves as a performance benchmark. A forecast is an updated estimate of likely results using actual performance and revised assumptions. An outlook is often a broader management view of expected direction, risks, and opportunities. I would use the budget to assess accountability, the forecast to guide decisions during the year, and the outlook to communicate potential outcomes beyond the immediate reporting cycle. Be sure to mention that a budget is an approved target, a forecast is an updated estimate, and an outlook communicates expected performance, while explaining how each supports different management decisions. Question 5. How would you investigate a significant variance against budget? I would first quantify the variance and compare it with the latest forecast and prior periods. Then I would decompose it into volume, price, mix, timing, foreign exchange, assumption changes, and one-off items. For example, an adverse claims variance may reflect higher frequency, severity, or reserve development rather than simply poor cost control. I would validate the source data, discuss causes with business owners, document the conclusion, and update the forecast or recommend corrective action. Focus on quantifying the variance, separating price, volume, mix, timing, and one-off effects, validating data, speaking with owners, identifying root causes, and proposing actions with an updated forecast. Question 6. Which insurance KPIs would you monitor in an FP&A role? I would monitor gross and net written premiums, earned premiums, claims, the loss ratio, expense ratio, and combined ratio for property and casualty operations. I would also review retention, new business, lapse rates, operating expenses, investment income, operating result, and solvency indicators. The key is not viewing ratios in isolation. I would analyze trends by product, geography, channel, and period, then connect movements to pricing, claims behavior, underwriting quality, expenses, and market conditions. Include premiums, claims, combined ratio, loss ratio, expense ratio, retention, new business, investment income, operating result, solvency, and the need to interpret trends by product, geography, and distribution channel. Question 7. What is the combined ratio, and how would you analyze a deterioration? The combined ratio equals the loss ratio plus the expense ratio and measures underwriting profitability before investment income. A ratio below 100% indicates an underwriting profit, while one above 100% indicates an underwriting loss. If it deteriorated, I would separate claims frequency, severity, reserve development, catastrophe effects, pricing adequacy, acquisition costs, and operating expenses. I would also compare product and regional mix, because growth in a riskier segment can worsen the aggregate ratio even when execution is sound elsewhere. Explain that combined ratio equals loss ratio plus expense ratio, identify the meaning of ratios above or below 100%, and discuss pricing, claims frequency, severity, reserves, expenses, and business mix. Question 8. How do International Financial Reporting Standards 17 and Solvency II affect FP&A analysis? International Financial Reporting Standards 17 changes how insurance earnings, liabilities, and service results are measured and presented, while Solvency II focuses on capital adequacy, risk exposure, and regulatory resilience. FP&A must understand both without confusing them with management KPIs. I would reconcile statutory, regulatory, and internal views, investigate differences in assumptions and timing, and maintain clear documentation. This matters because a profitable reported result may still require capital action, while strong solvency can coexist with weak operating performance. Mention International Financial Reporting Standards 17's service result perspective and contract measurement, Solvency II's capital and risk perspective, differences from management metrics, reconciliation needs, and the importance of consistent assumptions and data governance. Question 9. How would you prepare a monthly management reporting pack? I would establish a controlled timetable, collect actuals from approved sources, reconcile them to the general ledger, and compare results with budget, forecast, and prior year. The pack would highlight premium growth, claims, expenses, combined ratio, operating result, capital indicators, and key risks. I would use concise charts and write commentary explaining drivers, not repeating figures. Before distribution, I would perform reasonableness checks, confirm unusual movements with owners, and tailor the emphasis to management decisions. Cover data collection, reconciliation, KPI design, actual versus plan analysis, commentary, consistency checks, deadlines, visualization, and tailoring the message to executives rather than merely presenting raw numbers. Question 10. Describe a financial model you would build for an insurance business. I would build a driver-based model linking policy counts, average premium, retention, claims frequency, claims severity, expense rates, investment yields, and headcount to financial outputs. Separate input, calculation, and reporting sections would make the model transparent and auditable. I would include base, upside, and downside scenarios, with sensitivity tables for pricing, claims, and interest rates. Controls would include balance checks, historical comparisons, and clear ownership of assumptions before management uses the model. Discuss model purpose, driver-based structure, assumptions, operating schedules, outputs, scenarios, controls, documentation, and how the model supports forecasting premiums, claims, expenses, earnings, or capital. Question 11. How would you forecast claims and reserves for FP&A purposes? I would treat actuarial estimates as the technical foundation rather than independently replacing the reserving process. For FP&A, I would analyze claims frequency, severity, development patterns, catastrophe exposure, inflation, and changes in business mix. I would compare current experience with assumptions, understand favorable or adverse reserve development, and use approved scenarios to show uncertainty. Close coordination with actuarial, underwriting, and finance is essential so the forecast reflects both technical judgment and operational reality. Explain that FP&A should not replace actuarial reserving, but should use approved actuarial inputs, analyze frequency and severity, consider development and catastrophes, and communicate uncertainty through scenarios and sensitivities. Question 12. How would you assess the financial impact of an interest rate change? I would assess the impact through several channels rather than focusing only on investment income. Higher rates may improve reinvestment yields and discount insurance liabilities, but they can reduce the market value of existing fixed income assets and affect solvency or accounting results. I would compare asset and liability duration, model parallel and non-parallel curve shifts, and distinguish immediate valuation effects from longer-term earnings benefits. The analysis would include sensitivities and clear implications for profitability and capital. Mention investment income, asset valuations, insurance liabilities, discount rates, duration, reinvestment, solvency, sensitivity analysis, and the importance of separating short-term accounting effects from longer-term economic impacts. Question 13. Tell me about a time you improved a reporting or forecasting process. In a previous role, monthly reporting required several manual spreadsheet consolidations and took 4 days. I mapped the process, standardized input templates, added validation checks, and automated recurring calculations with Power Query. The close reporting cycle fell to 2 days, while reconciliation errors decreased noticeably. I also documented the process and trained users, so the improvement did not depend on one person. The main lesson was that automation works best when ownership, definitions, and controls are clarified first. Use a structured STAR example, quantify the problem and improvement, explain the technical change, mention stakeholder adoption and controls, and show how the result improved accuracy, speed, transparency, or decision quality. Question 14. How do you ensure data quality in an FP&A report? I use a layered approach. Start with approved source systems, confirm the reporting period and entity scope, reconcile totals to the general ledger, and test completeness and unusual movements. I maintain controlled templates, clear definitions, version history, and documented review steps. For key metrics, I compare current results with prior periods, budget, and operational drivers. If an issue remains unresolved, I flag its materiality and impact rather than quietly publishing a number that could mislead management. Be sure to cover source governance, reconciliations, completeness, accuracy, period and entity checks, reasonableness testing, version control, review evidence, and escalation of unresolved issues before publication. Question 15. How would you explain poor performance to a non-financial business leader? I would begin with the headline and quantify the gap, then explain the operational drivers in plain language. For example, I might say that profit is below plan because claims severity increased and expense savings were delayed, rather than leading with accounting terminology. I would distinguish temporary effects from structural issues, show the likely full-year impact, and present practical actions. I would invite the leader's context, confirm the explanation, and agree on follow-up ownership and timing. Focus on clarity, business drivers, visual communication, avoiding jargon, separating facts from judgment, quantifying impact, confirming understanding, and ending with actionable choices rather than simply reporting disappointing results. Question 16. What would you do if an executive challenged your forecast assumptions? I would first understand which assumption the executive challenges and why, without becoming defensive. I would review the underlying evidence, including recent actuals, operational indicators, external benchmarks, and input from relevant specialists. If the alternative view is credible, I would model both cases and show the effect on earnings, ratios, and capital. If uncertainty remains, I would document the range, decision owner, and rationale. Constructive challenge improves forecasts when it is evidence-based and transparent. Mention listening carefully, distinguishing evidence from opinion, reviewing source data, testing alternatives, maintaining respectful challenge, documenting assumptions, and escalating only when material disagreement remains unresolved. Question 17. How would you evaluate an expense reduction initiative? I would establish a verified baseline and define whether the target is gross savings, net savings, or avoided cost. Then I would model implementation costs, timing, recurring benefits, one-off effects, and any impact on service quality, compliance, or risk. Each initiative would have an owner, milestones, and measurable evidence such as headcount, supplier rates, or run rate expenses. I would track realized savings monthly and ensure validated benefits flow into the forecast rather than remaining unsubstantiated claims. Discuss baseline definition, gross and net savings, implementation costs, timing, recurring versus one-off benefits, service or risk impacts, ownership, measurement, and whether savings are reflected in forecasts and budgets. Question 18. Which Excel, BI, or data tools would you use in this role? I would use Excel for flexible analysis, including structured formulas, pivot tables, scenario modeling, and sensitivity analysis. Power Query and Power Pivot are useful for repeatable data preparation and large reconciliations, while Power BI can communicate trends and KPI drivers through interactive dashboards. Where available, I would use SQL or approved data tools to retrieve source information efficiently. I focus on controlled, documented solutions, because a sophisticated dashboard is not valuable if definitions or data lineage are unclear. Mention advanced Excel, Power Query, Power Pivot, SQL or data extraction where relevant, Power BI visualization, controlled models, automation, and the principle that tools must support accurate, explainable analysis. Question 19. How would you prioritize competing requests during the forecasting cycle? I would rank requests by deadline, materiality, management impact, regulatory or control importance, and dependencies. A forecast input required for an executive decision would usually precede a lower impact ad hoc analysis, but I would confirm priorities with my manager when conflicts arise. I would break work into milestones, communicate realistic delivery times, and reuse validated data where possible. I would not sacrifice core controls for speed. Instead, I would explain trade-offs and escalate capacity issues early. Cover deadlines, materiality, decision impact, dependencies, regulatory or control requirements, stakeholder communication, workload planning, and escalation of conflicts while protecting reporting quality. Question 20. What questions would you ask at the end of a Generali FP&A interview? I would ask how the team measures success during the first 6 months, which business units the analyst supports, and how the annual planning and rolling forecast cycles operate. I would also ask which KPIs management considers most important, how FP&A partners with actuarial and risk teams, and what systems support reporting. Finally, I would ask about the team's current analytical challenges and how this role can create the greatest value for Generali's profitability and resilience. Suggest questions about team priorities, planning cadence, business unit interaction, success measures, systems, current analytical challenges, development opportunities, and how FP&A influences strategic and capital allocation decisions. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.